Coming up in this podcast with Alexander Stahel, he doesn't hold back. From oil and copper realities to gold's unstoppable momentum and the shifting geopolitical landscape. Here's what you need to know before diving in.
Our money is mostly in gold and gold mining stocks, and we think that's the easiest way to make money at the moment for a 12 months outlook, and so I like easy. I don't like to go where it's complicated. America has a 36 trillion debt pile.
Yeah, and that's a problem.
So someone has to stop the bleeding, or this is getting out of control. I have a very hard time to see gold going much lower from here, and I don't have a very hard time to explain why gold could go much higher from here. So the supply side story is strong in oil, and the demand side story weakens, and the main reason is China. So I would really not recommend for people to get excited on oil exploration. The entire use of copper in the world, 25% of that is for the construction of everything in China. If that slows down, it compensates for a lot of whatever other demand or use there is out there. Number one. Number two, the green shift will not be implemented as advertised. We won't all go electric. My view is just that the demand is not growing as advertised, and that the supply will probably stay steady. And in all, I don't see this as being this disruptive copper bull unfolding right in front of our eyes.
Right. I'll look into the camera to start with, I think. Let's just say hello. Well, I'm here in person with Alexander Stahel for the first time. It's really nice to meet you in person. Of course, we've done a couple of podcasts over 2 or 3 years, I think. How are you doing?
Thank you. Thank you for having me. It's nice to have you here in person.
It's lovely to be
fantastic.
here in your house. So thank you for having me here in Zurich, of course, just after the Swiss Mining Institute, the SMI, up at the Dolder there. Before we dive in to commodities, mining, all that juicy thing, can you just maybe take 2 minutes just to remind our audience what it is that you do?
So Burggraben is a primarily commodity investor, but not so much in the commodity directly, but in related equity or debt products or securities. And Burggraben is a holding company that I created a while back when I came out of private equity. It's primarily my own money, but we also manage some client money. And our style is to be rather concentrated, so I would call it hopefully a Buffett-type template wrapped up in a cyclical commodity product. Okay,
and it's mostly for you, but you do have a few clients as well?
Yeah, we do have clients, to be fair, yeah.
Okay. And you were showing me your office there, so of course we've spoken on Zoom before, and you sort of give me a bit of an idea of how you model. Was it 1,000 plus you'd said you'd model?
Well, I don't know how many in total of all the companies, because we are still somewhat of a generalistic nature. But when it comes to commodity, we certainly take it very seriously. And so that means that we like to have all the 3 layers, as I call them, right. So that means the macro side, because I don't think you want to go against a macro wave in commodities. It just never works. As someone once said, if you don't do macro, macro does you. Okay. And then we have the commodity layer itself, so whichever one that is, base metals, copper, precious metals, gold, but certainly we did a lot of oil and gas, and we certainly understand certain parts of that market rather well, and we collect a lot of data on the sectors. So hopefully we are a bit of a big data company in that regard.
And then the
so we go the extra mile for the cycle. And then of course we are fundamental investors. That's my background, and so we try to see something which others not yet see. So we hopefully get some alpha. We can squeeze some alpha on top out of other than the cycle, also the company itself. And so those are the 3 layers, and. Because it's hard to get all the 3 right, it usually means that we have few ideas, but that's just fine. We don't need a diversified portfolio. I don't believe in diversification if you have the time to really study these things carefully. If you don't have the time, by all means, I think it's probably easiest to have an index.
Yeah, okay. And
so this is not investment advice, but in our case, we do that full time, and that's all we do, and we do it for a long time too, so 20 years, and we are fanatic about it. So and we have lots of other people helping us on certain topics we are not comfortable in.
I'd definitely say you're a data fanatic. Having spoken to you a couple of times, the facts you can just recall or you have in front of you astound me every time we speak. But I saw one of your models, thousands of cells long, effectively. And are you with the companies? You're effectively taking the information that's out there already and basically making your own model.
Yes,
as if you'd be the CFO of that company, maybe.
Absolutely, yeah. Or hopefully also, the numbers is kind of, for us, just normal to get right for ourselves and have a view and have the sensitivities around them. What does it mean if the numbers are such, and then you have a gold price of 2,500 versus 3,500, and I like to have those flexes in front of me and understand the sensitivity, the upside. But many soft factors in companies, like teams, who does what, why, over time matter at least as much. So we are focused on many aspects, including geology, but that's not where we come from. But there are wonderful people that we can call and get some help.
Okay.
Because as they say, in oil we have a saying: big fields tend to become bigger, and smaller fields tend to not come to fruition. Okay. And so you want to get the resource right, and that's true for all the metals out there, and it's true for all the energy commodities too.
So are you looking then at the deposit size scale? Because you mentioned to me before we started that if you're a gold company, unless you've got 5 million, it's not worth it.
I think it's very hard for small deposits that may be profitable on paper to get them to fruition.
Right.
These things are in places where there is little infrastructure. And I think casual investors tend not to focus enough on these aspects. By the time you have everything in place, either the dilution doesn't make it a good business anymore, or in most cases, I don't think they find the capital they need.
Yeah, okay.
So I think a 5 million ounce deposit is where it makes sense, 4, 5, 6. But then there is always a way for them to become bigger. Yeah. And that's why they make money, and that's why they get the attention of the best, call it industrial investors.
Right.
Because these days it's still a industrially financed industry. It's not that the capital markets are of much support. Yeah. It's really the royalty companies financing them. It's the big mining families financing them, or the in oil it's the majors, or there needs to be an exit strategy, and if it doesn't fit, or if it doesn't get the attention of those with deep pockets, in my view, it's probably a waste of investors' time. Although there is a lot of speculation on all sorts of timelines of these discoveries, but I tend to advise people to be careful there.
So it's not to say you can't make money at that other end of the scale there, but
well, on paper, right?
Paper. But for fundamental long-term wealth building,
I think it's best not to
go there.
I mean, if you're so exploration in oil, I don't think even exists anymore for small companies. That was true 10 years ago, where there was lots of funding for explorer teams out there that could find oil, and then there was, I would say, an orderly market where people could find things and sell it to others. I would almost argue that market doesn't exist anymore, because the majors that are the exit strategy, they're just not going to buy it from you, right? They wait until you go bankrupt and they take it over for nothing. Okay. So in oil, I think it's really not recommendable to go after exploration. In metals, it's different.
Okay.
Because in metals, you can really, on the drill bit, you can create a lot of value if a geologist team knows what they are doing. And that certainly works for all the commodities, whether it's base metals or precious metals. And so that's an exciting era if you know what you're doing. I would just say personally, I'm not good enough in that. And if I have to call up all sorts of people each time to get their advice, I'm probably a little late then too. So I leave that to others. But, once these things become clearer to everyone, then, we pay attention to them too. But exploration in metals works, but I would say it works for the specialists, for the geologists out there.
Well, let's just talk about oil then, since you mentioned that, and your thoughts on oil. I know that you're not that bullish on oil, really, in oil stocks. You say that there's no point in investing in explorers?
No.
Okay. So if you want oil...
10 years ago, that there was an industry like that. Today, I don't think there is. I mean, there are a few names left. I would say, out of 4 names that come to mind, and I don't want to mention names, 3 of them are frauds.
Right, okay.
So I would really not recommend for people to get excited on oil exploration.
On oil exploration. What about oil generally as a sector?
No, I mean, oil as a sector is going to be with us for as long as you and I live, and then another 100 years. It's the most important energy commodity out there. It literally makes markets. It feedbacks into macro. It's a fantastically important commodity to understand. It's a cyclical commodity, and I just so happen to go, with a carefully bearish and then incrementally more bearish view into it after 2022. In August, publicly so on Twitter, I said, look, I think that was a good cycle top, and it's getting harder. And I think that, in very basic, simple terms for everyone to digest, I think the supply side kept surprising to the upside, not to our surprise, but to many people's surprise. So the supply side story is strong in oil, and the demand side story weakens. And the main reason is China. So for the last 20 years, the incremental barrel each year we added in oil, which was about, between 500,000 to 1 million on call it 100 million market, that was China mainly, right? And then a few other markets such as India, but India has a much smaller base and is therefore much less important, incrementally so. But China was huge. And in my view, I rang the alarm, let me say it this way, in 2022, 23 louder, and in 24 I was convinced that I'm on the right side, that the transportation fuel peak is in. Okay, the transportation fuel peak. Not necessarily naphtha, not necessarily jet fuel, but I will be careful there too.
Okay.
But so I think the incremental growth story of China is over, mainly due to the extreme subsidizing of the electrification. Now, that doesn't mean they're going to roll over, because the base of cars installed in China is much too large for them to shrink. But I think the marginal car added is more or less electric. And then on the truck side, it's LNG that matters, because China is in a recession, in a structural recession, as we call it, for years to come. We can make a whole show on that too. But that element is so important for people to understand, and they should really not think about their own wishes, what China can be in the next 10 years. They should just accept what the data and what comes in and what it is. And so, because it's in a recession, the transportation sector becomes very, price sensitive, and LNG is a cheaper fuel for trucks than is diesel. And so there comes in another element that saves. Combine the two, and this is peak growth. Again, it doesn't mean they roll over. For everyone in your audience, I'm not predicting that China halves in consumption, not at all. But the additional growth element comes out, and in the past 20, commodities are about the marginal barrel that is added or taken away from the market. So they constantly price at the margin. They don't price on the 99% that is more or less stagnant. They price on what is moving at the very top of the barrel. And that element is gone. And then we have the OECD sector, so the entirety of what we call also the West, including Asia, right? But the West in a geopolitical sense. So Japan, Australia, and then, you know, the little ones in OECD Asia, and then Europe, and then the US and Canada. And these parts are either stagnant or slightly shrinking each year. And so what is left growing, right? Mainly India, which is at the moment not that strong anymore. But yes, there is an element, but again, the base of India is probably too small to grow, to compensate what is not growing anymore. It's probably too small a base to even compensate the shrinking element of OECD. And then everything else is just not big enough or relevant enough, right? It's not that if you see a population doubling in Nigeria in the next 20 years, that you're going to see a tripling of oil demand in Nigeria. It just doesn't work that way. And I think people don't pay enough attention to these things. China's industrialization was a very unique story to the world. And I don't see any country repeating that even on a smaller base. So I think people have to come to terms with the fact that China was just a miracle from industrial usage of metals or energy commodities, and we're not going to see anything like it in the coming 20 years.
Right. Okay. And so, I mean, on the general demand side of oil, then, do you see that just being kind of flat?
I see it flatlining. You know, until this demand rolls over, with some pockets, smaller pockets growing and some shrinking and some flatlining, I think that can take a long time. And it's probably also comes then down to the cyclical aspects of our global economy, what it is doing. So if we have a 2008 kind of financial crisis, then expect the margin to shrink, and then it can recover from there. But if we then probably in 10 years look back, then we see more or less a flat line. That would be my rough forecast, and without getting too stuck on these long-term forecasts, because we don't try to predict what is in 10 years. That's not our job. We try to just go where it's easy and where it's obvious. But oil to us is not obvious at all, because again, demand we think is challenged, while at the same time supply is just fine. You know, we have very strong pockets, especially in the Americas, from Canada to Brazil to Guyana to Argentina. Only those four make for a good story. Then we have the entire OPEC bloc, which is actually throttling demand when they actually want to bring new stuff on, and there is a lot of spare capacity, especially with core OPEC, so that being Saudi Arabia and the UAE and Kuwait, and so there is plenty of potential there, and then we'll have to see how that pans out. But at the moment, I just don't see a supply issue.
What about
so
the whole?
This is just not a bullish corridor. I think once the Permian rolls over, but like once it really happens, right? Because people were predicting this for 10 years now, and it didn't. In fact, it grew each year, right, on top, and it's probably growing again this year, because these American entrepreneurs are just very, very good in becoming more efficient by using less rigs and so on. And so one has to be respectful of them, and that is actually not a bullish thing for oil, but that's actually a bearish in oil. And so once the Permian really rolls over, because it's such a massive story for the supply side of oil over the last 10 years, then I think it gets more interesting to look at oil again. But I just don't see that bullish corridor yet.
Okay. And what about the whole Trump drill, baby, drill thing? I mean, because on the one hand, I think, well, that's very bullish for the industry, going to fire up, the oil men of the United States. But at the same time, he probably wants lower prices at the pump, doesn't he, for the Americans?
And he'll get it, I think.
Right.
So I think he will certainly cheer on his industry, but I'm not even sure his industry changes much.
Right.
Because I think they all became much more aware of their shareholders and debt holders than they were 5 years ago. And that's in all a good thing for the industry and for the shareholders. there is this thing called tier 1, tier 2, tier 3 kind of locations. So it's a very, location-driven affair, pumping oil in America, in the Permian. And I think the best locations have largely been used up. At least that's what some of the Permian producers are saying. Now they have a way to, to say what is fashionable, but there is probably an exhaustion there on tier 1 locations coming sooner rather than later, and that in itself makes it harder for them to just grow from here, the base. So I also don't see growth coming in a, unexpected fashion because Trump cheers on the industry.
Okay.
I think that's also unrealistic.
Right.
I just think they do what they do, mainly the big boys. They are the by far largest producer in the Permian, and we can share some numbers for your audience after this interview. Mm-hmm. But I think they just have a business plan and they execute on that, and they're probably not going to change it much within a window of, call it 55 to 75 WTI. But that's, by the way, also, what is drilled is highly price sensitive. So I don't think they're going to drill themselves into a bear market by themselves. I think where the bear market comes from in the coming weeks is actually from geopolitics. Because Trump is actually, the US president still has by far the biggest soft power of all presidencies out there. And Trump hates high oil prices because he knows it's very, popular in his base to produce lower prices, and that's a good thing all in all for the US economy. But so how do you deliver that? And I think you deliver that by opening up some strategic spigots, right? And that's, again, in the Middle East, in core OPEC, and now over time, he's done so very successfully in 2018, right? When he said that he's going to, toughen sanctions on Iran, and then he actually gave them a waiver for 2 quarters, while at the same time the Saudis were pumping more because they assumed some Iranian oil comes off the market, and it didn't. And then we had this huge crash in Q4 2018, which, by the way, was a very scary moment for my book, because I was then still a bit too naive on Trump policy, on Trump's ability to affect the oil price, and I paid dearly for that. There was a big mistake on my side. It's not going to happen again. So I am, when it comes to Trump, I'm very respectful of his ability to influence the oil price down.
Sure,
so now, I'm not saying it all happens according to a book, but he has a way to influence players, and I think that's still, the Saudis have learned from that too. It hurt them too. But you see, they held back oil for too long in a market that was actually, weak for the last 3 years. And I think they want to bring some of that capacity back. They are still producing about 1 million below their natural quota, Saudi Arabia. And I think we're going to see a shift there. So I made a long tweet on it about 6 months ago, and hopefully you can share it with your audience, where I explain it in detail and in all the data, because I think people should be very careful here. I wouldn't be surprised to see, by the summer oil, let's say Brent in the below 60.
Right.
That wouldn't surprise me. It doesn't have to happen in a disruptive way, but for sure I don't see any bullish sign here for oil to go, call it from 70 back to 90. I have a very hard time to put that case together.
So for you, you're not looking at oil, you're not investing in oil at all. I mean, just...
Right now, I don't do that, right? Because I just don't see what I call a bullish corridor, where it may, where we can buy stocks cheap. They aren't particularly cheap, the best ones, or they even, second tier, but good company, good, well-run companies. They aren't cheap. I don't see, this wonderful corridor we had between, call it 2020. Post-COVID, the shock, and 2022, where more or less for 2 years everyone was too bearish until it all switched, and then the geopolitical aspect came on top with Russia and sanctions and the uncertainty that created, and oil overshot to over 120 dollars per barrel. We need some capitulation before we get to the to a more interesting entry point in oil.
Okay.
In the cycle of oil.
Interesting you say that, because I just want to talk a little bit about finding the real small end of the market. Probably too small for Burggraben, but I mean in London, which is where I'm very focused on the markets, it's pretty tough in the sector in general. There's certainly a lack of capital, lack of confidence in the sector. It's become very much, I think, a trader's market. But I did take my first oil stock a few months ago, real small. I mean, the company's only worth, it's got £1 million market cap, and they had a full change of management. They've got fields producing, not massive, in Texas, about, I think it's 80 barrels a day, looking to double that throughout the course of the summer with new wells. And they're forecast effectively to profit effectively £2 million per annum on that. So for me, looking at a company that's worth about £1 million, which is very little for a listed entity, I see that as like an obvious sort of upside there. And I am following money as well, because there's a big investment, very sophisticated investment manager in the UK, who has been building a position in that and now has 20%. And his, when I was talking to him, doing a podcast with him, I asked him about this company. I said, what did you like? And he said, well, they're going from pre-cash to cash. And that's what I'm looking for at the minute, is when companies are going to start moving into revenue. I mean, that's obviously too small for you, but are there still little pockets of that kind of thing?
I would never exclude finding these kind of opportunities for individual investors, but I would always advise to be very critical going into these things, because in an extractive industry like oil, usually what it means is there is a lot of capital needed, and then you always have to ask, so how is this capital coming into the company? What does it mean for dilution? Can they really deliver? What is the team behind that? These kind of things. We did invest in call it startups, or what is called a development project, right? In Peru, as you know, in the company called Petrotal, a while back in 2018, and we held with it even through the COVID cycle, right? And that was the right choice to make. But the deposit was just, A, conventional, and B, because I don't like so much unconventional in America, these deposits. But so the conventional deposit was just outstanding. And there was, the price was cheap, and there were some very, very interesting aspects after putting in, weeks and weeks and weeks of work and due diligence and talking to the ministry in Peru and, understanding each aspect there. And then we still got, in some parts disappointed politically at time and so on. So I think what I'm trying to say is, in these cases, you need to have kind of a no-brainer story. Total no-brainer story with a lot of upside, and then be prepared that on the way things happen that you didn't expect, that you didn't see. In our case, also on transportation. And after the COVID, we had a lot of local protests and so on. So the case has to be good enough to withstand all these disappointments, and then for you still to have a good risk reward. And so there needs to be a lot of a margin of safety, as Buffett would call it, and for us that usually means like 300-500% margin of safety, right? Because these extractive industries have a way to disappoint. And
I think when you say 300-500, I asked this fund manager what would be a good return for a fund like you. Are you talking 2, 3, 4 times? And he said, absolutely. That's what I'm looking for. And if it goes up 10 times, we're not going to complain. But is it realistic? Probably not. But 3, 4, 5 times. That's enough on oil. I mean, at the SMI, and as everyone will know, gold, before doing extremely well. I have a little stock ticker that sits on my desk at home, and over the last 6 months, every day I'm just looking at it, it's just going up and up and up every day. And a big theme from the SMI was gold. There were a lot of gold companies there, big gold investors there, and it was almost, when things are too good, when optimism is so high, and then you start having alarm bells, you're like, okay, probably time to exit. I almost got a sense of that at the SMI, with the discussion panels that were going on, the chats that were going on. Everyone was really buoyed up about gold. But their general sentiment, and the people who are on the panel, you've got the likes of Villa Middelkoop, for example, Swiss investment firms were there. The whole consensus was that gold is carrying on its trajectory. I think Middelkoop called gold to 5,000 in 18 months' time. And there was a technical analyst out of a Swiss bank who again made the technical case for again a bullish case in gold to get to 300-400 throughout the summer, with what he called cold showers, $100 to $200 pullbacks, very short-lived. When everyone's talking and excited about gold, should we still be excited about gold, or should the alarm bells be going?
Good question. There's a lot to unwrap there. So, after let's do it the other way around. Before the invasion of Ukraine by Russia, gold was more or less trading on real rates of the United States. A real rate is the difference between the nominal interest rate and the inflation expectation. So you can do that on a 5-year interest rate term, US Treasury, or you can do it on a 10-year. And some do something, a cocktail of that, and then you do the same for inflation expectation. Not the CPI, but the inflation expectation. You deduct these two, you get real rates, and if you then overlay that with the gold price, you had almost perfect correlation over a period of 35 years. So to understand gold pre the invasion was to understand American central bank and inflation politics and realities. That has completely broken down. These correlations are irrelevant. But by the way, why was that then so? Because the marginal ETF, the gold ETF in the United States, in Europe, was the marginal buyer or seller of gold, and therefore did the price. So we actually also on Twitter published some of that, and hopefully we can provide a link to your show so that people can read up on these things, because we more or less documented for everyone for free to verify and look at it, and it's very easy, and there is no secret sauce about that. So people shouldn't make it more complicated than that. But since the invasion, something changed. What changed? Well, it's that with the seizing of Russian treasury notes and bills in the hundreds of billions. I think Euroclear holds 180 billion Russian interest rate fixed income products since the invasion, only in Europe, and then there is the American part on top. It means that certainly in call it in the emerging market world, people suddenly understood that maybe it isn't the safest place to invest into US treasuries or European treasuries on that basis, and that actually these things can change, and politicians can take a view, and they can take actually your asset away, or at least freeze it. In the Russian case, it's still a freezing of assets, right? It's not legally taken away from them, but it's frozen, and interest rates are used to fund some of the support for Ukraine. Okay. So that's number one aspect. But then there is a second aspect which many people overlook, and again, I refer to fundamentals rather than having. We are not technical traders, and we are certainly not traders. So we try to look at these things fundamentally once the dislink happened and see what is happening on demand and supply. Simple. So the second aspect that happened was actually China. And not so much what the Chinese central bank is doing, that too, we'll get to that in a moment, but what actually Chinese retail is doing. So you and I in China, what would we do at the moment? And what happened in China, in my view, in simple terms, and we documented that on our Substack in detail, is that the Chinese real estate sector got into a bubble over a period of more or less, call it certainly after 2014, got in a bubble territory that increased until more or less 2021 when COVID hit, or 2020 and then 2021 when COVID measures hit. And under the leadership of Xi Jinping, he decided that it's the time to burst the bubble. At that time, the average household wealth in China meant that they held about 70% of their wealth in a form of real estate, for an apartment or a second apartment or third apartment, for either just as a store of value or for speculative purposes. So more than just your own home. So it was more than just for living, it was for speculation. And that was decided at the CCP level that this should stop, and for the right reasons. So that must be clear. Just the measure they took were so extreme in something that they called at the time, or the media called 3 red lines, where they more or less burst the entire development sector, meant that you are now having a sector that's not going to revive, and a sector that was, that is priced sky high. So some of the most expensive real estate is probably in the first 20 cities of China that I couldn't even name, right? When we measured, the price and put it in context to the average income of a Chinese household, so it's really expensive to buy Chinese property, and we don't think that's coming back. So we took the time to really look at that in detail. And as we did so, also because of other things we do in investing, because when a property bubble bursts, it usually has a huge effect on the overall economy, as it did in Spain, as it did in Japan, in Spain in the 2000s, in Japan in the 1990s, and so on. We then suddenly discovered that it actually had a huge effect on, where Chinese put in their extra money, and that happened to be gold. So they bought a lot more gold. The retail did. So it now in China, where it's hard to invest in the stock market because you don't know, stock market is more or less a function of what the CCP supports or not. So it's hard to make money there, and the stock market is flat for 20 years. So that isn't much of a choice. You don't have interest products that yield anything useful. So that's also not a choice. And the property side, where you invest most of your household wealth, is now destroyed as a store of value, or at least you don't want to put extra money in it right now anymore, for very many different reasons that we explain in detail on our Substack. Means that there is almost no alternative to gold in China, in my personal view. So that drives gold too. And then you have all the central bank behavior due to geopolitics that we explained. And that doesn't just go to, the usual behavior of Asian countries like India or like China, but it also goes into Europe. So the Polish National Bank bought a lot of gold last year in 2024, extra gold and so on. So there is something going on there. So we have that aspect. And then on top now, believe it or not, but Trump added another aspect to the gold story. to call it the marginal buyers of gold. And that is the fact that he has probably what people call, his administration wants to do something that people call the Mar-a-Lago Accord, which is kind of a resetting of the global monetary system. And we all have to see what they are up for. We don't know yet where this is going, but what we do know is that it already affects the gold market. How? Well, there has been a lot of repatriation of gold from Europe, from the London bullion market to the US. And in my view, one aspect is the risk of tariffs, but I think that's the smaller aspect. I think the bigger aspect is risk management on the part of institutional holders of gold in the US, where they repatriate for the sake of not getting physically, squeezed or, being short of the physical gold that they own on paper, but not,
not in hand.
Not in hand. And so that's a big driving force at the moment, in my view, where there is a lot of, it's kind of a musical chair game where we have to see how it all pans out. And I don't want to stand here and say, look, there is a physical squeeze going on gold right now, right here. But if I would read that in detail, it's a very opaque industry, the physical gold market. And I cannot just call up 3 people and have the exact numbers of what is in the vaults of the London bullion market, right? And we have an audit and we know exactly who owns how much by, So that's not how it works, right? And it didn't work that way for 25 years. And for good reasons, because those who owned gold wanted to, gold doesn't have a yield, right? They wanted to make some extra money, so they leased out gold, physical gold, to all sorts of players. So we have to see who owns what now. And there are some very good commentators on that aspect, which we follow carefully. But it's always a speculation about what is really happening, because at the end of the day, no one knows except those involved in the trade themselves. But what we can observe is the trading flows, and they are clear. So there is a lot of gold moving from Europe to America, so call it repatriation. I think one element is tariffs, but the other element is risk management, and so that no one gets a short on their physical gold, and they suddenly only have it on paper. And I think that drives gold too. And so we now actually have a market on top where when we get lower real rates, then on top we have what so far drove the market that adds to this gold story. So I have a very hard time at the moment to see where weakness comes from fundamentally in the gold market. Now, can it come over a period of 2 to 3 months where, in November we had a short pullback on gold? Yes. But fundamentally, has anything changed on geopolitics? On the insecurity of all sorts of emerging market players in the Middle East or Asia about what they should own for, when they get income in US dollars? No, probably not. They are probably less secure about US treasuries, and they want to own a bit more of something else. And that is probably, gold or other assets, or maybe even Bitcoin. I don't want to make a Bitcoin pitch because I'm not good enough in that part at all. But, there is an asset diversification going on global scale from, way beyond retail, that will have an effect, and that there seems to be a new bit every single time when no one expects it to be out there. And so we'll have to see. I have a very hard time to see gold going much lower from here. And I don't have a very hard time to explain why gold could go much higher from here. Now, I don't find it very useful for anyone to put numbers to it, because, again, I don't know enough about those opaque details that are kept secret for good reasons. And therefore, I don't find it very useful to throw numbers out there and then get people excited, and then these things don't happen over a certain time scale. But, we are in a monetary experiment where the US tries to get rid of some of it interest payments on top, so they call it the macro picture on gold. And I think that too will create uncertainty that drives people into a direction of owning something else other than fiat currency. And that is in play too. So I think it's a long-term game here. It's probably going to pan out over 5 to 10 years. I see a lot of pockets of demand, fundamentally. I think there are state players involved that have things in mind that probably will be announced that can have an effect on gold. So there are many pockets of strength and not a lot of weakness. And on that part, I think this can take a long time.
Okay, so it's physical buying of it. China, central banks, and people in the United States who want.
Let's call the pockets. I would call it Asian retail. So you have the Indian jewelers and the cultural aspect of it, of taking gold for something else than we do, as they really look at it as a store of value and an alternative and an inflation hedge. So that happens in China, and it happens in India, and in China on top we have a burst of the bubble of the real estate. So there is no alternative kind of situation, and they, by the way, have a very functional retail gold market with the Shanghai Gold Exchange, which we don't have here in Switzerland or in the US or so on. So then we have the central banks throughout, all of them, but I think the China central bank is probably the most important, but many others on the margin too, that buy more gold since the geopolitical events in 2022. So they are marginal buyers too, when they weren't for 30 years. If anything, they were marginal sellers. So then we have, call it the repatriation of physical gold into the United States due to the, Trump administration. And then I think we have the debt aspect geopolitically, or too much debt in the US. And the uncertainty creates for all sorts of players being in fiat money where they look for alternatives, right? You cannot just go out of US debt if you are a big pension fund in the US, but you can start to lay pipes around it and say, okay, let's have a bit more of something else as opposed to nothing, right? So I think there are many layers involved. And on top, don't forget, we had what drove the market before 2022, which is the ETF that holds physical gold that functioned on real rates. As real rates went down, the opportunity cost of holding gold, to call it the most safe asset in the world, went down. So therefore, people bought more gold as real rates went up. The opportunity cost of holding gold went up, so people sold gold. But if anything, I think we go in an interest rate or real rate environment that is probably favoring gold on top. So I have a very hard time to see where the sellers come from to get gold, say, from 3,000 back to 2,500.
Sure.
While I don't have a very hard time to see where the buyers come from to keep a bit on the gold.
Okay. There was some, I think it was more of a joke really, but a lot of the driving of the gold price was the repatriation to Fort Knox, because maybe it's empty. I mean, I don't know.
No, I don't think it's empty, but I would. So it's. There is a question of title. Who owns what where?
Yeah.
And there are some very, I think, good voices, much more capable than me, that made, and we will provide you the links to them, because they speak on podcasts and on Twitter about it. And I think it's worth for your audience to read up on these things, because it's real. And, I would like to see, rather than Elon or Trump going through Fort Knox and making it a kind of a reality TV show, I would love to see America saying, okay, by the way, KPMG, PwC, some of the big auditors, you go in and tell me exactly how many tons of gold we own, and by the way, count it. Right? Just as we do for every company each year. It's great that the CFO tells me of a mining company how much cash he has on the bank, but I actually find it very comforting to know that an auditor actually looked at that bank statement and confirmed that the money is actually there. And so I think that's a good thing, if the US would do that, and Musk tweets about it, so that gives me an idea that something is brewing.
Yeah.
And I think that has probably a lot to do with why we see imports. So it's not that they don't have a lot of gold, but the question is, do they have the amount of gold that is reported?
Yeah, that's reported, exactly.
And that's a bit more than 8,000 tons, right? And, if it's there, then why don't they just do an audit and each year and say everyone that the gold is there, everything is fine, and it's not leased out, and we're not quite sure whether we get it back.
Exactly.
Right?
Yeah, exactly. Just a couple of other things. So you mentioned, I hadn't heard of that Trump's Mar-a-Lago.
By the way, just for your audience, right, in the real world, when things get difficult, possession is 99% of law. Just so, even if you have a title, but the thing is somewhere in London, and the London Bullion Exchange doesn't deliver you the gold, America is not immediately going to send the Navy SEALs to get that gold, right? It's more complicated in the real world. So all I'm saying is, there is friction there, and I'm quite sure the friction is real. Otherwise, everything we see in terms of flows at the moment that we can measure doesn't make a lot of sense.
Okay. This Trump's Mar-a-Lago Accord, I hadn't heard of that. And you say it's like a monetary reset. Does that tie into then the debt of the United States?
Yes. So America has a 36 trillion debt pile.
Yeah. And that's a problem.
And that's actually just I call it the balance sheet aspect of it, but the real problem is the flow aspect of it, that they make more debt each year, right? So someone has to stop the bleeding, or this is getting out of control, because at some point the interest rate payment has a way to get out of hand, and as it gets out of hand, it can actually ruin the US economy, the strongest and biggest and most important for the world. And for anyone out here, who doesn't like or likes or dislikes the United States under its current administration, whatever it is the most important economy by far to the world, and so everyone should hope that they get it right, because that's better for the world. Okay. So, number one. Number two, so the question for this administration is, how do we get the interest payment, let alone the debt pile that is growing each year, but the interest payment down? And there are ideas out there. And none of them are official, obviously, right? But some of them are communicated so clearly that probably they're also not so unofficial either. And I think one plan of Mr. Bessent is to convert bonds of US Treasury bondholders around the world into zero coupon bonds. Now, I'm not sure he's going to solve anything long term with that, because again, we are talking, the key, in my view, reason, or the key aspect to fix in the United States is the leakage. That every year 4 to 6% additional debt addition from supporting its economy, because the US economy is 20% government driven, and if you reduce that by 6% in order to have a balanced budget, you actually have a huge recession. So someone needs to get on it, and Elon says, look, we have to reduce waste, and that's the entire Doge exercise. But I think we will all find out that this is everything but easy in reality. There is a lot of talk, and I think once we look back in a year or two, we say, well, not much happened.
Right.
Because the scale is so big.
Yeah.
That you really have to change a lot of things to reduce the leakage. Anyway, in the meantime, it seems the Mar-a-Lago Accord is about reducing the interest rate burden every year that they need to pay. And one idea there that seems to float is that they could try to convince their US Treasury holders to convert some of their debt, like France and Britain and Switzerland, to hold that, to keep holding that, but instead of having a 5-year or 10-year treasury note that they hold in the vault, and where they get a yearly interest payment, to convert it into a zero coupon bond product that they, get paid back in 50 years or 100 years. And then everyone says, why would I do that? Are you guys crazy? I'm totally not interested. And then probably the administration comes and says, by the way, we are the police of the world, and we're protecting you here and we're protecting you there, and therefore, you should do that, and you are our ally, and let's help each other. And if that's true, if that's the plan, I wouldn't understand why Trump at the moment tries to alienate all his allies. Instead of schmoozing, making a charm offensive, and and saying to Canada, by the way, you're our best neighbor. We couldn't wish for a better neighbor. And by the way, you don't have much of a military, but we take care of you. By the way, would you mind, swapping some of your 10 years for a 50-year zero coupon bond? Maybe he has a conversation there. But if you tell everyone that they are idiots and they do everything wrong, and by the way, we're going to put tariffs on you, I don't think that lays the fertile ground for these kind of conversations. But my understanding is, anyway, I'm not part of the administration. They hopefully know what they are doing. As an observer, I find it's slightly unusual, you British would say, what they are doing, and we'll see where this is going. But at the end of the day, I think that's one plan of getting the interest burden, the annual interest burden of the United States down.
And then you've got inflation as well, because everyone thinks, people in this space, that the debt will be effectively inflated away. And it's me and you, the normal person, that will pay the price for that with increased costs effectively. And again, that was the consensus of some of the panel at the SMI, was the debt's going to be inflated away. And that is also what's driving gold, because gold always front runs. It's an inflation hedge, isn't it? And it front runs QE, it front runs liquidity. So we're going to see more liquidity, we're going to see more inflation, and effectively diluting the debt through simply inflating it away.
We'll have to see. I mean, inflation comes and goes with the economic cycles the most. Yes, there are, in situations like COVID, we can create a supply side shock, which then creates inflation. But usually inflation is a demand side phenomena, which has the biggest effect usually, right? And for the last 30 years, certainly so, with the exception of 2021.
Okay.
2022. So we'll have to see how that pans out. If anything, I would probably be a bit more deflationary.
Really?
We have a very deflationary China, don't forget.
Yeah.
Right? China, in my view, is not growing. And by the way, everything that I look at in China, prices come down, don't go up. So we have a very deflationary China, which is by far the largest exporter of the world. So they're going to export, if anything, deflation. And then we have to see how everything pans out on tariffs. And I think that's a very complex topic that I find very hard to quickly wrap up and say, this is what it is. I think I leave it to the Goldman Sachs of this world and some, fantastic macroeconomic economists out there to come up with their views as opposed to me commenting here for your audience. There are other things I know better.
Sure, but you're not seeing an inflationary
environment. I don't think the next step that is ahead of us, when I say the next 6 months, 9 months, I don't see an inflationary shock coming. If anything, I see flat or deflationary momentum coming in the United States and certainly in Europe. Certainly in Europe.
Yeah, okay, yeah.
I mean, and then everything is constantly moving. Everything is a moving target, right? And so Germany just came out with this, massive amount of new debt they'd like to make. The Merz government is trying to put a coalition together, and where they, the final votes happen this week in the Bundesrat, and is yet to vote. we'll have to see whether they get it over the line. Probably they do. And then you could argue that some of that is inflationary. But we'll, again, have to look in detail what it really is and where the money flows. At the end of the day, it comes down to understanding the spending rather than the debt package.
Yeah.
Right? And these things are never easy because there are lots of, local interests that get served. And so I'd be careful just to say, okay, here comes 4% inflation in Germany. I think it's way too complicated to get that right. And by the way, we use some very good services on that side to look at all the data and be precise. And so
it's the physical buying of gold. It's not necessarily the inflation.
Gold is a demand supply story, and people should stick to that. I wouldn't make it more than what we just discussed. And these are huge aspects that I discussed, right? And they should make everyone kind of comfortable. I'm certainly comfortable on it.
Sure.
Even if there is a small drawback. So I think gold is definitely a buy the dip story. While for most other commodities, I would say, oh, guys, please. I mean, copper, from time to time, so many copper bullish pockets here and there. And I'm thinking like, guys, with China consumes 50% of copper in the world, and everything is on is on a lifeline and is struggling and is clearly in a recession and is clearly deflationary, and people are bullish copper. I mean, are you kidding me?
Before we get on and finish with the commodities generally, just on the gold, when you say buy gold, are we talking the physical? Or are we talking buy gold stocks?
Well, that's for everyone everyone has to know what they are and where they belong. I think if you are an average English household that wants to save and make sure that the purchasing value of his or her pocket or pound stays the same, then you probably want to have the physical delivered to your house and store it somewhere safe.
Yeah.
You probably, if you do physical gold, do it at your home. It's not good enough these days to have it at HSBC and think, okay, they're going to take care and I have it somewhere and they send me a monthly statement saying, by the way, your gold is there. Then you might as well just buy an ETF.
Yeah.
Right?
Yeah.
It's the same.
Yeah.
So either physical means delivered to your home and you store it somewhere safe, and you can do that, right? Or then you might as well just have a good ETF product of the physical side. Okay. And there are good ones out there. I'm sure you can help your clients finding them. Sprott has a good one in Canada and so on and so forth. And then if you have time and the knowledge and the competence, you should look at the miners. But the miners only work when they are the good ones that doing the right things and don't have their own cost side or do all sorts of operating mistakes. At the end of the day, when you go into the mining space, you add an operating leverage or even financial leverage to the game that you need to understand. And if you understand it, if you're competent in it, it's a wonderful space to make money and find value for the long term. And it isn't even that speculative at all, in my view. And if that's not what you do, or if you don't have the time because you have a job, then I recommend to stick with simple products or the blue chips.
And then you mentioned there, just quickly...
By the way, royalty companies is an idea that people can do.
Royalty, not so big in the UK, but I know it's big in North America.
Well, royalty companies like Wheaton or Franco-Nevada are probably some of the best business models in the world, because they take out the operating leverage of the mining company, and they get a claim on the deposit that is around, and a monthly check or yearly check on what is sold and mined there. And these are fantastic businesses. They tend to be expensive, but when gold price goes up, they tend to go up too, and over proportionally so. So these are, there are many royalties out there, royalty companies listed out there that I think are actually, solid investments. We don't do them because we have higher ambition for our clients and ourselves to find value, but in general, they are good companies.
So other commodities then, you said to me, you don't think the commodity sector is going to be too kind to investors. Interesting you mentioned copper, because everyone seems quite bullish on copper. Everyone talks about the EV revolution. Everyone talks about AI and how it's going to consume more energy and have to use more copper. But you're not feeling copper and other commodities in general.
And the problem there is that people have so many feelings and they tend to shortcut the numbers. And if you do numbers like we do and supply and demand, and we mean mine by mine, country by country, in detail, then you understand that people shouldn't have these feelings like, data centers and so on. Yes, they are real and the demand there is real, but 50% of copper is consumed or used, is the correct English word for it, because we don't consume it. It's not something that gets wasted. You can use copper more or less forever. Mm-hmm. You can recycle it forever. Copper is used in China 50% globally, right? Of that, 30% of that 100% China cake, 30 to 50% at times went into both construction and housing.
Okay.
So infrastructure construction, so roads and trains and streets and God knows what, right? Creating China, and on top housing. So those were the two big ones.
Okay.
So I would say roughly a simple number, 25% goes into China construction. And I was just explaining a moment ago that this sector has completely collapsed and will stay in the doldrums. Nothing's gonna recover there easily, even if Xi has a big program, which he does not, to save that sector, which he should have, and he doesn't. It's as if this entire sector, which is massive, it's like bigger than the rest of the world combined, in China alone, is his enemy. And the problems they have in the sector, if you drill into and really encourage people to go on our Substack and read up, where we made a 6-series explanation on it in detail, really for everyone to understand, hopefully in words that everyone can digest. But once you read that, you cannot be bullish copper, you cannot structurally. Now, why is then copper going up right now in America, but by the way, not in the rest of the world? Well, it's simply because, again, of these tariffs, where people repatriate some of the copper and hoard it there. Oh. Oops.
Let me plug that in. We'll only be 5 minutes, I think. Okay, well, we're back. We've got some light back. I think we've been talking too long, but we don't want to finish off on copper. Yeah. So, you were saying people have got it wrong, particularly when it comes to...
I don't want to accuse everyone of having it wrong, but I think in general there is a misunderstanding, or there is too much bullishness from, in general, the green shift saga, which is true. If it would be converted as advertised, we would use a lot of additional copper, or would have to use a lot of additional copper for the electrification of everything. So that's in general a true statement. But we'll get back to that in a moment. And the second thing is this AI additional consumption of electricity for data centers that again needs more copper. But again, so the entire use of copper in the world, 25% of that is for the construction of everything in China. Mm-hmm. If that slows down, it compensates for a lot of whatever other demand or use there is out there. Number one. Number two, for your audience, for simple digestion, is the green shift will not be implemented as advertised. We won't all go electric, even though in Europe maybe more so than in other places. But so far, if we observe what is happening after the signing of the Paris Agreement, where everyone committed to less CO2 emissions, is that actually only the Europeans, and they're also in pockets, I would argue, only the British, only the Germans, and only the Dutch, and a few other countries like Denmark actually have a CO2 plan, while everyone else is actually not paying attention. So China at the moment constructs 2 coal power plants a week.
Really?
Does that sound like less CO2 emissions? No, and we can measure that for your audience. You can, everyone of your audience can go on a website called The World in Data, and then go on CO2 emissions, and then do it at country level, not at per capita level, because the climate doesn't care about per capita. The climate cares about total emissions or CO2 output. And you'll see that China is just growing its CO2 output over proportionate to what Europe ever could save, right? We are far too small a footprint on the global scale, while even India and smaller emerging markets like Indonesia and so on already overcompensate what we could ever save. So just on, I think, finally with the Trump administration, they also exited, call it the CO2 emissions or reduction scheme, right? And so I don't see a big shift in America coming either. And so I am very doubtful about the electrification of much outside Europe.
Right.
So Europe in itself is too small a pocket to compensate certainly what is not constructed in China today. Again, 25% of copper use is construction of either houses or infrastructure in China. And that is collapsing, right, since 2022, and only goes in one direction, down. Less housing construction, less housing completion, less everything because they actually have a debt problem. So China is bad news for copper. Mm-hmm. And now finally to the data center pocket, I think people want to be careful. So the high transmission lines, the high voltage transmission lines are usually aluminium, not copper. And then the end distribution of electricity is actually quite copper intensive, but again, far too small in terms of what needs in additionally be done incrementally. I'm talking now, 25, 26, 27, 28, to actually bring copper into what I think is would be a deficit. So I just don't see the deficits coming on demand and supply. I hear them everywhere, I read them everywhere, but I don't see them coming in our numbers when we do the hard work.
Okay.
And I think people tend not to do the hard work there. If anything, if there is a demand pocket that people may underestimate, then it's the ammunition and, you know, the defense industry pocket that actually needs copper also for all sorts of things. But look, we just don't see the copper bull at all. And if American prices are currently appreciating way above the London, the LME price in London, and certainly so the Chinese Shanghai price, then because of tariffs and a false repatriation of copper, which I think is very temporary and is actually a trader's paradise for arbitrage of the metal between continents, right? And so I'd be very careful, because the arbitrage actually between China and America at the moment is so high, like it has like nothing we've ever seen, ever, right now, right here as we speak. And so if I'd be Trafigura, a metal trader, or any one of them out there, I would try to arbitrage that and make a lot of money by selling copper out of China into the United States and making a fortune for no risk other than transportation and time. Mm-hmm. So we'll see how easy that is. It's probably not that easy, in reality, and I'm not an arbitrage player and I'm not a physical copper trader. But when something is as good as it is now, people find a way to arbitrage it. Mm-hmm. So I would be also careful to just go out and say, by the way, it's not easy, therefore it won't happen. It will happen. Mm-hmm. And people will get innovative about it. So there is, in my view, there is no structural copper bull at the moment unfolding. And I had a different opinion in 2021, but then we had still, the implementations of that green shift that I thought were lasting. But at the moment, I just don't see it. I don't see it in Asia. I don't see it in the United States now. And Europe is left. And if Europe continues unilaterally to push the electrification, all we will get is actually a deindustrialization of Europe, because we more or less shift our industrial base to other places so that we save emissions. You get a mass unemployment, so I think there will be a big backlash from the populations, which we already see. And so I think that is also not going in a straight line. So I'd be very careful about the green shift.
Well,
as a mega trend for more copper demand.
Has your view changed then? Because you said in 2021, and the first time we spoke, I can't remember if it was 21 or 22, but I remember the podcast very specifically because you made a lot of quite strong statements, and you said that if we're going to go down the green shift, it's going to be one of the greatest moments to be alive in the commodity sector. So has your view changed then?
My view has changed, as I just explained. So I don't think Europe will be able to go as consequence as advertised about the green shift. I just don't see how we can afford that, do that unilaterally without everyone else doing it too. Right? Number one. Number two, we just saw the America exiting under Trump. Number three, we don't see in 2021, we just came out of COVID and China was actually very loud about going green too, although with a deadline of 2060 instead of 2050 like Europe. Right? But since then, when data unfolds, all we see is more coal, more this, more that. And yes, they do electrify, as I mentioned in oil. But that doesn't compensate what they don't use in construction. Again, it's about the numbers. The construction sector is the big user of copper. It's not the EV. Right? EV adds a lot versus an auto engine in terms of copper need. But when you compare it to the housing market, where there was more or less one Germany built each year for, 10 years in China, it's just Mickey Mouse. You can have as many EVs as you want, they're not gonna overcompensate what is lost in construction. So it's a numbers game, and the more we looked into and digged into numbers and look at them, the less I see the green shift materializing the way I did in 2021. And many demand pockets are actually increasing, but others are decreasing, and they are the big concern here to advertise a structural copper story. Now, on the supply side, just quickly, yes, it's not easy to have these new copper deposits and bring them online, and it takes forever. It takes 10, 15, 20 years and so on. But people are on it. My view is just that the demand is not growing as advertised, and that the supply will probably stay steady. And in all, I don't see this as being this disruptive copper bull unfolding right in front of our eyes. And, we stick on that on a yearly basis. And, if in 26 we the numbers change, we change our mind. I don't think people should get too religious about these things. Commodities trade on the margin. And so we have to look at those aspects instead of forecasting the next 20 years.
Indeed. So just finally then, on where you're positioning at the moment, what is attracting you at the moment, where you're positioning your money, your clients' money. Don't name names, but I'm talking sectors really, that perhaps our audience can take away and perhaps consider as the sector to kind of have exposure to at the moment. So again, we're focusing on cyclical things, although we were also in defense in Europe. But we went out of this as it increased, in our view, beyond the fundamentals in place at the moment. But our money is mostly in gold and gold mining stocks. And we think that's the easiest way to make money at the moment for a 12 months outlook. And so I like easy. I don't like to go where it's complicated. Sure, okay. No, that's a simple answer. Well, thank you so much. That's a really good talk. Thank you very much, Alexander, for sitting down with me here in your lovely house in Zurich. Thank you. Thank you for having me, Mark. Okay, good. So, we have that together. I think that should help. Yeah, that was brilliant. I think that was about an hour 20 in total. Good. But I think it was, we touched on topics. Yes. If you enjoyed this interview, then give us a thumbs up, a like or a retweet. Subscribe to us on YouTube or follow us on Twitter and hit that notification bell to be the first to know when we release new content. There's loads of great content on our website too, across all our programs at stockboxmedia.com. Thank you for watching.